Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwagu. Today on the show, Goldman Sachs sees sizable moves in interest rate cut in Egypt. IMF says South Africa at risk if economic reforms don't materialize fast. And Tanzania secures $1 billion syndicated loan from TDB Bank for infrastructure. We get the show started now with the markets, and we begin with intraday numbers from the stock markets in Africa, where the South African bourse is taking the shine with a 0.63% gain, unaffected by the dwindling economic growth warned of by the International Monetary Fund. It's a different story here in Nigeria, where the all-share index was down 0.06%. In Egypt's EGX 30 index edged up 0.08%, while the Nairobi Stocks Index closed Tuesday's session negative. It was also a mixed bag of numbers in the Middle East at intraday. In Abu Dhabi, the index was down 0.05%, while Dubai's index rose 0.24%. In Saudi Arabia, the benchmark index rose 0.14%, with RG Bank and Saudi Basic Industries increasing 1.3% and 0.8% each. However, Qatar's index slipped 0.19%, led by a 2.5% fall in Qatar International Islamic Bank and a 1.1% slide in Masiyed Metrochemicals. And European markets traded slightly higher this morning as investors track positive mood music around the U.S.-China trade talks. Well, let's bring in Ulrich back now to bunch all of that together for us. Hello, Ulrich. Good afternoon.
Hi. Good afternoon. Nice to be with you.
Good to have you. Well, no fireworks on Wall Street, but it was enough for new all-time highs for all three major indices. Are investors in Europe taking the cue from Wall Street?
Well, I think at the beginning, here in Germany at least, yes, but things are starting to peter out again. The Dax only holding on slightly to gains, a more clear picture in London with the FTSE 100, but the CAC 40 in Paris is flat, and shares are dropping in Milan. So the enthusiasm was waning quite quickly, despite Donald Trump saying that he was close to a trade deal. But there have been these kinds of statements so often, and then retractions from that, and then answers from the other side. And nuances coming in, like suddenly phase one and phase two, playing a role, further complicating the interpretation, at least from the point of view of the market participants here. And I'd like to give you the voice of one market strategist from the United States. He said the people would like to see that talk is one thing, but they'd like to see an actual deal on paper, pen to paper. That would change the narrative for the market. But that we're not seeing yet. We're seeing indications it might be close, but that's what's keeping markets on their toes and shares, at least in Europe, sort of treading water.
And it's record highs again and again in New York these past days. Now, the German DAX has not advanced into record territory so far. Only a matter of time,
I think it's only a matter of time. It's surely up there, near record territory. It's hovering over 13,000 points, around 13,200, 300 in the past few days. And the old record high was at 13,596 points. That's about 2 to 3% on a good day. That's 2 days movements. On 2 good days, in other words, the DAX could be there, but it's just not making that move. And some people think that the DAX will eventually get there. One bank, for example, banks are coming in now with forecasts for 2020, says that at the end of the year they see the DAX at 14,000 points. That would clearly be a new record, but also it's a quite a careful, quite a modest forecast of what the DAX potential is for 2020. When people hear assessments like that, I don't know if that would exactly motivate them to jump in at these levels at the moment.
Okay, let's look at a slew of important economic data scheduled for release in the United States, and second readings for GDP and private consumption in third quarter, as well as weekly jobless claims. Could that breathe more life into the markets?
Certainly it could. It would have to be a surprise, though. From one of the indicators, that could be jobless claims or that could be private consumption, both extremely important in the Fed's decision-making policy or policy decision-making on rates. And depending on which side it comes out on, the markets would react to, let's say, more likely rates coming to the benefit of the markets or not. And I think the key figure today will be the GDP. It is the second assessment. The preliminary one was earlier this month. But if it's anything other than 1.9%, it would be a surprise. And then you'd see, I think, the share prices jump here.
All right, Ulrich, let's continue to keep a tab on those numbers. Enjoy the rest of the day.
Thank you.